Hey, good afternoon, everybody, and happy International Women's Day. I'm looking around my screen and I couldn't be more excited to show you this incredible panel of professional women who are here to talk to us today about everybody's favorite topic, your taxes. It may not sound all that exciting, but I'll tell you what, it is super exciting to know that you have done your taxes, that you're getting maybe some money back, and that you've gotten it all taken care of and nothing is going to go wrong and cause you problems. We're hoping that today you can get some information, particularly if you're coming from a low income background, that'll help you to be able to meet all the filing deadlines, understand about different kinds of claims. And then next week, we're going to come in and talk a little bit about different tax credits you might be able to take advantage of if you have a disability, or if you are if you have a person with a disability who's a dependent. I've got a really wonderful panel today. I'm going to start off and have the folks from Washington University introduce themselves, and then you'll meet Sue, who's one of our amazing tax volunteers at the ARC, and then we'll have a presentation. So I think I'm going to start with Sarah. Can you tell everybody a little bit about your background, Sarah?
Sure, absolutely. Thank you, Sharon. So I am Sarah Narkowitz. I direct the Low Income Taxpayer Clinic at WashU. And what we do is we represent pro bono for free taxpayers at or below 250% of the poverty line once they are in controversy with the IRS. So we'll talk a little bit more about that today, but it's exactly the scenario Sharon says you don't want to happen once you get that letter from the IRS and something has gone wrong. So with me today, I have Jenny Stoll, who works with me here in the clinic, and then our amazing student, Samantha, who's going to do the presentation, but I'll let them introduce themselves. So Jenny.
Hi, I'm Jenny Stoll. I'm a supervising attorney for the Low Income Taxpayer Clinic here at WashU. I've been with the clinic since 2019. Thank you. I'll pass it over to Sam.
Hi, everyone. I'm Sam, or Samantha Roloff. I am a third-year law student about to graduate in just a few months, which is really exciting. It's crazy. I've been a student attorney in the Low Income Taxpayer Clinic for the past year now, and I've really enjoyed it, and I'm really excited to present to you all today.
I'm so excited to have all three of you here. So that's our legal representation. We've also got two amazing folks that volunteer their time at the ARC, helping us out with tax returns every year. Sue, can you introduce yourself?
Yes, I am Sue Steinlage, and I've been with AARP Tax Aid for about 10 years, and the ARC always has interesting returns.
Well, that's an excellent way to leave that. And Bob, I'm so glad you were able to join us.
So like Sue, I'm a volunteer through the AARP auspices to do tax returns. And our focus is on, of course, seniors because we're ARP, but also low income and people with disabilities. So here we are, and I'm glad to be part of this group.
We're so glad you're here too, because you guys might have that accountant answer that is going to answer some of the questions for folks that are on the call with us today. And I just want to give a shout out to AARP. I don't think everybody realizes that there are multiple organizations that are really out there to provide free tax preparation. And we're so very fortunate that AARP is a longtime partner with the St. Louis ARC. A lot of our residents, our staff, families can bring tax returns to us, and these guys are going to help you get your taxes taken care of.
Yeah.
Without further ado, Sam, I'm going to give you control of the screen and the crowd, and let us know a little bit more about the clinic.
Sounds good. So we will get into my portion of the presentation today. So again, we're from the Low Income Taxpayer Clinic at Washington University. Who we are. So we are one of 131 low-income tax clinics nationwide. We are federally funded, and basically we are an academic clinic at the law school, which means that the attorneys that work with our clients are student attorneys like myself, but we are supervised by attorneys Sarah and Jenny. So thankfully they're great tax attorneys and they're great supervisors. So we're not just on our own. So that's who we are. And what we do is we provide free legal representation to qualifying low-income individuals with disputes with the IRS. So like Sarah said, we work in controversy. So people come to us once they get some sort of notice from the IRS. Typically, we assist in a multitude of issues such as audits, appeals, collections, litigation. We prepare anything from offer and compromises to just, assisting with your standard audit, kind of anything along the federal tax controversy gamut. And then we can also help respond to notices from the IRS and then correct account problems as well. I've had a few clients that my job is to just call the IRS for them and just check in on the status of their refund, because sometimes our clients don't have time to wait on hold with the IRS, but I do, because that's my job. So we can really do a multitude of things for our clients, which is really great. What we don't do, we don't prepare tax returns. So I'm really glad that we have some folks here who can do that for you all. And then we only provide legal advice on federal taxation because we are federally funded. We don't provide legal advice to our clients that we take on anything else. And we don't really work in state matters. So to get into the topic for today, filing your taxes. So when to file your taxes. This year, it's Monday, April 18th. It's usually April 15th, but that falls on a Friday this year, which is also a federal holiday in DC that they're observing. So it's Monday the 18th this year. It's important to note that in 2021, the date had been extended because of COVID. And so just know that we're back to our normal April deadline. You can file an extension until October 15th, but if you are going to owe money on your return, you need to make payments in the meantime, in between that April and October, to make sure that interest and penalties don't accrue, because they can really accrue and add up. How to file your taxes. So you can file electronically with the IRS, or you can mail a paper copy of your return to the IRS. We really encourage all of our clients to file electronically, because if you are entitled to a refund, it can be directly deposited into your account. It's just processed a lot faster when you file electronically, and it just seems to overall be a little bit more efficient. That said, the IRS has a free fillable form for individuals with an income of $72,000 or less and are comfortable completing their own return. That said, we really encourage all of our clients to take advantage of services such as VITA, which stands for Volunteer Income Tax Assistance, and TCE, which stands for Tax Counseling for the Elderly, which I believe you all use. And then people like Sue and Bob here today with AARP to help you file your taxes for free, because I think it's not known to a lot of people that there are a lot of free services with really qualified professionals that know what they're doing to help you file your taxes, which can prevent a lot of problems on the back end. We see a lot of clients that just made a common mistake in filing their taxes, which led to an unfortunate controversy. So it's nice to kind of use these services on the front end and help where we can. So we really, really encourage all of our clients to look into VITA, TCE, and whatever free other services may be available to you. So the topic for today is when an adult child with disabilities can be claimed as a dependent. So we all know that a child under a certain age can always be claimed as a dependent, as long as they're not claimed as a dependent on someone else's return. But today we're going to focus on when they're over that age requirement. So there's two ways for that to be the case. They can be a qualifying child, or they can be a qualifying relative. And if you meet one of these two tests, you can claim an adult with disabilities as a dependent on your tax return. So the first test is the qualifying child test. And so to be a qualifying child, to be claimed as a dependent on a tax return, it's a 4-part test. You can be under 19 or permanently and totally disabled. And if you're deemed to be permanently and totally disabled, then you don't need to meet that under 19 age threshold. And the IRS defines permanently and totally disabled in 2 parts. They say that the person cannot engage in any substantial gainful activity because of a physical or mental condition, and a qualified physician determines that the condition has lasted or can be expected to last continuously for at least a year, or can be expected to result until death. So that's the first part of the test, is that you're either under 19 or permanently and totally disabled. And then you need to be a descendant, which means a child, a sibling, or a descendant of a sibling, which means a niece or a nephew. The person must live with you for at least half of the year. And then the person cannot provide more than half of their own support. So an example for a qualifying child could be your niece that is 20 years old. They're deemed to be permanently and totally disabled. They live with you in your home and you provide all of their expenses. This test is a little bit more stringent than the qualifying relative test. So if you don't meet the qualifying child test, there's still options to be claimed as a dependent on the return, specifically if the person is not found to have a permanent and total disability, or they don't live with you for half of the year, they can be a qualifying relative by meeting this test. And there's also no age requirement to be a qualifying relative. So the test for a qualifying relative is they are either a child, a sibling, a parent, an aunt or an uncle, a grandparent, or a niece or a nephew. So as you can see, it's a lot broader than being what fits for a qualifying child. Their income cannot exceed $4,300 in 2021. And it's important to note that income is any payments that aren't exempt from tax. So this includes any Social Security disability payments that's included in that income threshold. There is an exception, however, for income that derives from working at what the IRS defines as a sheltered workshop run by any tax exempt group or government. So kind of a group work situation. I'm sure you all with ARC would know more specifics about what would qualify in those situations. And then they also must provide more than half of the person's support. So an example for a qualifying relative would be, let's say your parent, they live on their own, but you provide 3 or 5/6 of their support and their income doesn't exceed $4,300 for 2021. That could be a qualifying relative and you could claim them as a dependent on your tax return. So if you meet the qualifying child or the qualifying relative test, you can claim them as a dependent on your tax return, even if they are over the age of 19. How to claim them? I feel like I've told you what makes, someone a qualifying child or a qualifying relative, but it's nice to know exactly on your taxes how to do this. So on your Form 1040, there's line 6 for this, and you basically just report the person's name, report the person's Social Security number, and the person's relationship to you. But it does not end there, because what's really, really, really important is that you keep detailed records that they meet the qualifying child or the qualifying relative test. We have a lot of clients come to our clinic just being audited by the IRS, and half the battle in responding to these audits is just to show that whatever credit they're claiming, whether it's the EITC or something like that, that they were eligible to claim it. So if you were to claim, someone as a qualifying child on your return as a dependent, it's important that, we show that you have the records that you met this test. And so it's easy to show that someone's lived with you for half the year. It's easy to show that someone's your niece or your nephew or your child. And it's usually easy to show what their income is. The hardest thing to show is the support test, so that you provide over half of their support. And so basically the way to do this is you just need to keep track of all of the person's costs for the year. And then you need to keep track of what you pay and what they pay. And this can include anything listed here and more. So food, lodging, clothing, education, medical and dental care, recreation, transportation, kind of all of the expenses it takes us to live. So if you provide over half of those, again, you meet the test for qualifying child typically, but the IRS will sometimes push back on that and audit it. So it's important that you can come back with these records and give them to them and say, no, I really do meet this test and can claim them as a dependent. So that is our topic for today. Here is our contact information with the clinic. Sarah Narkowitz and Jenny Stoll's contact information. There are 2 supervising attorneys, like they said, and then this is our clinic's information.
I was just going to start through our questions, but I did want to clarify, and I don't know if this is a question, Sam, you can answer if we need to turn to our um, tax folks, but I just wanted to talk about substantial gainful activity because that seems so vague sometimes to our families. Are they using the determinant from Social Security? Substantial gainful activity is more than $1,350 per month. That's an official piece of language from Social Security. So is that the same standard?
I would say it is not, it's not used. That standard is not used in the code, but it, you know, the IRS and Social Security work very closely together. Every information return that you receive goes through Social Security first. So while that's not parallel, it's probably related.
I think that's important for our families because that's considerably more than $4,300 a year, not including SSDI. So that's really good for everybody out there to pay attention. Substantial gainful activity may be more than you or less than you think it is. So no, more than you think it is. So you should be eligible to be able to file. Yeah, let's go ahead and start answering questions. And Sue and Bob, if you have any comments in regards to the actual tax information, by all means, jump in. So one of the first questions was just how will you typically be notified from the IRS if something's wrong with your tax return?
So I will start. You know, it's almost always via mail. It's not true that the IRS never calls you because they will call you once you are really, really well down the path. If you are not responding, for example, if you filed a tax court petition, chief counsel will call you to talk to you about your case. But the first notice is always going to be via mail. So if you get someone calling you up and telling you that you are going to jail because you haven't filed your taxes and you haven't heard anything about this beforehand, that's a scam, right? We get so many clients that are being audited and they're terrified of going to jail. That's not, I mean, you have to do something really, really, really bad before you go to jail. So you will get a letter and the letter should say, you know, IRS. We see a lot of fraudulent mail as well. If someone has a lien, for example, against their property, scammers will go down to the courthouse and find those liens and send you very scary looking letters. So if you ever get a letter and you're unclear, you know, call us and we'll be happy to tell you whether or not it's legit.
I hadn't even thought about scamming, but that must be a very profitable enterprise. So I'm glad you brought that up.
Yeah.
So expect to see stuff in your mail, not a last minute threat of jail. That's really good advice. And Sam, you mentioned that if you're going to ask for an extension and you know you're going to owe money, you have to start paying. Do you know what kind of interest the IRS typically charges if you owe money? What happens if you can't afford to pay?
I don't know off the top of my head the interest rate. Do you?
It changes.
The
Yeah.
interest rate is currently 3% on the amount that's owed, and it's going to go up to 4%. I forget the exact date, but pretty soon.
Yeah. They change. How often do they change? By quarterly? Is it?
I think it's every 6 months, but I'm not
It's
sure about that
okay.
part.
Okay.
A
Take the
lot-
second part.
Okay. Yeah. So a lot of the clients that come to us, or I would say most of our clients that come to us can't afford to pay their tax liability. And that's why they come to the clinic. We have a variety of options that we can provide for our client that can't afford to pay. So there's an option called currently not collectible status, which basically just the IRS can't collect on the liability while you're on that status, but we have to prove basically that your expenses exceed your income, or there's a very, very small threshold. There's an option called an installment agreement where we can work something out with the IRS that you don't pay in full right away, but you pay in small chunks. And then there's something called an offer in compromise where we basically say that you'll never be able to pay this liability. It's a really long process. I'm working on one right now and I've been working on it for a while. But we offer the IRS a certain amount of money to settle the liability, and they will either accept or reject it. Am I missing any alternatives, Sarah?
No, I think it's important though to realize that the IRS seems very scary to the average person, and there is nothing more terrifying than getting one of those letters in the mail. But they're actually a very reasonable organization, hard to communicate with. They're completely understaffed, but very reasonable in working with taxpayers that are making an effort to settle their controversy. And it's not always the taxpayers owe money. Sometimes taxpayers are right, and the IRS is wrong in their allegations or their audit. So each situation is different.
So an installment agreement is basically just an agreement with the IRS that you pay in, smaller chunks and not all at one time. Am I missing anything on installment agreements?
Just a couple of thoughts related to that. Typically, they'll want at least $25 a month, and they will send you a bill once you set up one of those agreements. And they do charge you most of the time to set up those agreements, but not always. And that's where that interest rate kicks in. If the unpaid balance, you're paying interest on it, but they want at least $25 a month.
Thanks, Bob. Sue, I'm going to shift gears to you because you in your introduction said that you get some interesting tax situations with the ARC. And I'm just wondering, I want Bob to answer too. What are some of the kind of common either pitfalls or challenges that you see with the folks that are bringing in their taxes to you? Do you have any tips for people that are doing it on their own and maybe there's a misstep that is happening regularly?
Yeah, it feels like it would be nice for them to just come to us to do their taxes instead of trying it on their own for a lot of people. But, I can't think of anything typical about SLARC.
And that goes for the staff too.
Well, I know. I think the staff have often multiple jobs. And, I'm sure a variety of situations with credits for school and children and all kinds of other things. So I would think it gets very complicated.
Well, a few of the odds and ends that bite people sometimes, people that are self-employed, they're not aware that they're going to end up having to pay Social Security and Medicare on the amount that gets reported to them as income. And they're shocked. And then since they're self-employed, they're both the boss and the worker. So they pay both halves, and that all of a sudden, well, I shouldn't owe any tax. Oh, I owe $1,000 or whatever. Bad news. Trying to sort out family situations is a real challenge sometimes. Not more so at some of the other places we work than with you, but sometimes that's a very challenging issue. Most parents that we run into where we're doing education credits for them, they don't remember how many years they've done the American Opportunity Credit. And you can only do that 4 tax years. And if they get it wrong, it's not pleasant. Let me just put it that way. Let's see, what are some?
Has anything with the ABLE Act impacted taxes?
The people, well, it impacts Missouri. Because if you put money into an ABLE account, you're able to reduce your taxable income in Missouri. And there's limits on that. I can't remember exactly what it is for ABLE, but it's kind of like when you put money in a 529 account, you get to subtract that amount from your taxable income in Missouri. But there's a couple special things for tax year 2021 that because of COVID and some of the special relief programs they put in place. For this year only, they have made some big changes to how the earned income credit is calculated, which will definitely benefit some of your residents. They've raised the amount for individuals who don't have dependents to like a single, it's about $21,000, and you can still get earned income. They've tripled the amount of earned income credits you can get. You can get up to $1,500 in that situation right now. The other thing they've done, which is once again challenging to put the pieces together, they've allowed that if you wish, and if your 2019 earned income is greater than the 2021 earned income, You can use your 2019 earned income to calculate the 2021 earned income credit. And you can do that even if there's no income in 2021. So zero income in 2021. Oh, I don't need to file a tax return. Well, if you happen to work in 2019, you can. The other thing, they changed all the age limits. It used to be you had to be over 24 and under 65 to do earned income credit. Not anymore. If you're independent, you can be 19 and you can be.
All right, Bob, I'm going to have you prepare yourself for next week because we're going to talk a lot about tax credits. And I think we'll make sure people get on that have detailed questions about that because it sounds like you guys are really digging in and getting some fun stuff coming up related to earned income credits.
Well, and the other thing that just, and I'll get off the soapbox here in just a second, that is that you can be 100 years old and still get the earned income credit. So like if I go become a greeter at Walmart, I might actually be eligible for earned income, even though I'm bumping 80 years old.
Nice.
So, okay. Similar benefits for if you get a child independent care this year, they've made some nice changes to that are beneficial. And then the child tax credit is nuts. It's just crazy what they're doing there. So, okay.
So all of these are really good reasons for you to go to a professional. I'm going to go back to what Sue said. And if you are confused about the changes that have been made this year, if you're feeling like you're struggling with the papers when you pull them up, contact us. Let us know you need a little bit of help. We've got these wonderful people here to help you. I have a couple more questions I want to make sure we get to before we run out of time today. And one of them is, how do you prove someone is living with you? Should you have a rental agreement with them where you show that they're paying you rent, or that they would be expected to pay you rent because they live with you? Or is it more of a something that they just believe you?
They never believe you. I can tell
I
you
didn't
that.
think that was going to be the answer.
So I would say mailing address is super important. So if the mailing address matches, if there is a school involved, your school records, if you are working, whatever address your employer has on file, medical records. So if they're occupancy permits, or if they're living with you, then and you're leasing, then there doesn't have to be a rental agreement, right? But if you are renting, they should be on the lease as someone in that residence, but otherwise occupancy permit. And the IRS never believes you, right? So documents are key.
Yeah, I really like that part of the presentation. I was thinking I might want to schedule an organization Q&A because I think families that have a member with a disability have such an enormous amount of paperwork to manage that it would be really helpful to get some support with that. Okay, so I've got one more question, and I think it's going to be for Bob and Sue, but let's see. It's about if I owed taxes in a previous year, and it's something I can fix with my employment forms with my employer. Are you able to advise people on how and what to claim in order to avoid owing the next time they have to pay their taxes? So if you maybe haven't taken enough out of your previous paychecks or whatever, on the front end as tax folks, can you say, next time go in and do this?
Well, yes, I think that we can encourage people to withhold more if it's an employer situation, because I think a lot of times they're just really surprised that they were, especially if there's multiple jobs or multiple people with jobs, they're under withholding. So yeah, we do encourage them to do that.
Great.
And an easy way to think about that, Sharon, is let's just say they end up in a surprise, they owe $500. And they say, I don't want that to happen next year. And you say, okay, so you're $500 short. You need to accumulate that much more in withholding. How often do you get paid? Every 2 weeks. Okay, so you got to get 26 pay periods, got to get $500. Make sure they take out $20 more every pay period. And
wow, look at that. You did the math right in your head. I can tell you are a CPA. That was good.
Oh, you'd be surprised at what I am. I'm not a CPA.
No. Well, your
No.
math skills are stellar, Bob.
Oh, thank
Love
you.
it.
I'm flattered.
I'm going to do a quick circle around so that anything that you want to share today that we haven't talked about yet, you can jump on and tell people your one last important piece of information. And I'm going to start with Sam.
Oh man, one last piece of advice. I would say just always seek help if you feel like you are maybe confused or lost, because I think one thing I've learned as being a student in this clinic is just how much can be prevented on the front end and what a headache it can be on the back end. So that's my piece of advice. And it was really nice to get to talk to you all today.
How about you, Jenny?
I would say that even if you think you're going to owe and you can't afford to pay, still file. Always make sure you file on time.
I love that too. You guys are good at this. Sarah.
Well, that was going to be mine, but I guess I will go with, if you get a notice in the mail, please call us, because it's complicated, and we'd be happy to talk to you. And again, thank you so much for having us today.
Sue, how about you?
No, I just want to thank everybody else for presenting. I think that's a fabulous, service that you're offering. We will certainly be advising people to contact you.
Please do. Thank you.
Wonderful. And Bob, last but not least.
Okay, two things. One, never ignore a letter from the IRS. Always respond somehow. And secondly, remember you got 3 years to deal with a tax situation before you lose the right to get a refund that might be due to you.
That's something
April
I just
15th.
learned. Yeah, so I that sort of dovetails onto my advice, which really means nothing to you because I have no expertise, but we've been doing a lot of financial wellness training here. And one of the things that I really thought a lot about is that even if you're not earning very much money, you definitely should go in and file taxes, talk to somebody, because you might be due a refund because of these credits, and Bob and Sue can help you to get it, and you've got multiple years you can go back and check. So don't miss those opportunities to put dollars in your bank account or your ABLE account. So this is a good opportunity. Thank you, everybody.
Bye-bye. Thanks much. Appreciate you.